Hi, I'm James Kirby, Managing Editor of Eureka Report. Welcome to the second in our series, talking to listed investment company managers. Today I'm talking to Karl Siegling of Cadence Capital, very successful in recent years as a fund manager, market cap of about 140 million. Hi, Karl.
How are you?
Now, tell me about your track record just in recent times. Give us an idea of 5 years, 3 years, 1 year. How have you been doing?
I think in over 1 year, we're about in line with the market at the moment. Over 3 years, we've probably accumulatively 100% ahead of the market. And I'd say over 5 years, cumulatively about 150% over the market.
And your investment style, to the extent that you are distinct from other funds, tell me what you do that's
Yes, I suppose we look at the world quite differently. There's 2,500 companies listed in Australia. That's 2.5% of the world's market capitalisation.
Yeah.
700 of them made a profit last year. That might be a startling fact for many people. 1,800 of them did not make a profit last year. And of those 700 companies, 90% of them, or 630 companies, are what we call truly average. They have average cash flow, average free cash flow, average PE, average amounts of debt, average amounts of cash, average management, diversified income stream. They're essentially pretty uninteresting. That makes up most of the top 200 in many cases. And, and so because they are so truly average, we're not really that interested in them. What we're interested in are the 5% or 35 companies in any given year that are cheap, and the 5% of companies that make a profit, or 35 in any given year, that are expensive. We spend our whole day visiting companies to try and eke out those 70 companies, the 35 cheap ones and the 35 expensive ones.
Well, you've had a tremendous run, that's indisputable, from when in the last 5 years, and they weren't easy years for anybody. You can long short, of course, and there was times where you had shorting right up to 30–40% of your portfolio. Today it's down to nothing. Is it 2% or so?
Almost nothing. I think if people go to our newsletter, you'll see that we have a short position on OZL, Oz Minerals. We've had that on since about $7.50, and the stock's about $3 now.
But
$4, I beg your pardon, not $3. I'm hoping it's
Now, looking back at this last year, that you're in line with the market is not a great return compared to what you've been doing previous years. And you have a lot in banks and financials, which to the naked eye would appear to have done very well. So what did something else catch you this year?
Yes, I think what the issue for us is is the second component of what we do, which is once we've identified those cheap stocks and those expensive stocks, the trick for us then is to scale into those positions. We're quite risk averse in the way that we enter positions. We start with 1%, then 2, then 3, then 4, then 5%. So when we came into this new bull market, for want of a better term, we were holding very, very high levels of cash. At some stages we were holding almost 80% cash. And so what we did into this bull market was go into it 1% at a time in each stock. So it's taken us quite some time to get to reinvest it, and we're still holding about 30% cash. So what you'll find is you'll never see us suddenly be all in or all out because we woke up one morning and we had an epiphany that something was going to happen. We don't run money like that.
Now, tell me, talking about how you run money, one interesting thing you were telling me was about when you get a corker of a stock and it really pays off for you. You've had one or two of those, RHG, most people don't even know who they are. Just tell me about the story about that stock.
So let's go to the theory behind it. The theory of modern portfolios says if you put 20 stocks, you have 5% in each, then you've diversified away 80% of the risk in the marketplace. So then you've got 5% in each, and you're going along, and one of them doubles and becomes 10% of your portfolio, and one of them drops 20%, it drops to 4% of your portfolio. Now, that's the mathematics of the situation. The reality of the situation is if you let a 5% position in most institutional portfolios or most institutional mandates in Australia grow to 10%, you'd get fired. You'd lose your job.
Even though you're making money.
That is not the
problem
point.
Is that you're knocking out the proportions.
You've got to get yourself index weighted, you've got to get yourself back in. You
so you're ignoring all that.
So there's another theory of life, which is what I do with my money, and a lot of my money is invested in this fund, which is you let your profits run and you cut your losses. Incidentally, the second component of that is in the institutional world, if you do cut your winners, all you can do then is add to your losers. You've got no other option really. So
what about new winners? What about new winners?
Oh, you can try and find new winners, but then your probability of finding them is the same as us, except you've cut your winners. So so we do let our winners run, and that can look quite unusual to many investors, because they've been taught for many, many, many years that maybe, as I term it, don't let your profits run.
Yes. So your allocations will look
don't let a good
different
position. I mean, RHG, we started buying it at 14 cents when they had 28 cents of cash in the bank. I mean, that's strange enough to think about now,
sounded
right?
good for a start, yeah.
Someone was paying us 14 cents to take the stock off their hands, and it was still earning 24 cents for the year. So we paid half a PE for it as well. And we've just let the cash accumulate and let the stock price go up. Now, in an institutional environment, well, the good part about that, first off, is an institution wouldn't have been able to look at it. So tell me, when it was a $1 billion company, they could buy it. But when it fell to $21 million, they weren't allowed to.
This is their mandates, which can be so restrictive. Now, tell me about the year ahead. If you're starting the year even, Stephen, and you have still a big propensity for financials, are you confident on financials in the year ahead?
So what happens in the year ahead is we let the financials continue to run if they're profitable, and if at some stage, and I'm increasingly beginning to think when and not if, at some stage when people realize that this dividend yield that they've been
obsessed with,
manically buying, it's so much so that, for example, a Commonwealth Bank, I don't want to single them out, but they're on 3.5 times book value. At some stage, someone might wake up and say, gee, that's expensive.
Yes.
Or the dividend story ends, or something happens. And, back in the 80s, the banks were trading on 1 times book. Now they're trading on 3.5 times book. That's 350% of the relative valuations they were trading at in those days.
Yes.
So just to put things in perspective, that's to understand how expensive something can get. And you should never forget how expensive something can get and how cheap something can get, especially if it's listed on the Australian Stock Exchange or any other exchange in the world.
So you're looking afresh at this, and just can you give us some sectoral view as to where you're looking, or is it bottom up entirely?
So actually the diversified financial services, some of them don't look too expensive on an operating and free cash flow basis. They look interesting. Resources, many people who've been in our fund for a long time will remember that resources made up 40% of our portfolio.
Yes, so you're quite willing to go in there.
Well, they were very cheap, and then they continued to run. And remember the days when it was stronger for longer, stronger forever.
Yes.
Chindia, China, India, all that stuff.
Absolutely.
It's all gone now. So now that resources are collapsing and collapsing and collapsing and collapsing, you would expect a fund like us not even to be anywhere near that space, and that is true. What is looking increasingly interesting is cyclical stocks, industrial cyclical stocks. Another distinction that's occurred over the last year, which I think will continue, is the small caps are down 5% for the year, and the large cap stocks are up 20% for the year.
Which is almost, I won't say unnatural, but it's clearly perhaps suggests a phase.
Now here's the interesting thing: if you're a man that can only run small cap stocks because that's your mandate, you can't buy big cap stocks. So luckily for us, we have an open mandate, and we have migrated quite well into larger cap stocks. So a lot of our stocks are sitting in the larger category than would more traditionally be the case. And why is that? Because those are the stocks that are cheaper, have the better operating cash flow, the better free cash flow, and those are the stocks that we have accumulated and let run. Again, this concept of an open mandate. If you didn't have an open mandate, you couldn't do that. On the other hand, if you had a mandate that said you only were allowed to buy resources stocks, well, you would have been buried.
Well, it's, I'm sure, terrific for you to have that mandate, and we wish you very best in the year ahead.
Thank you. Thanks very much for your time.
Thanks, Karl.
Thank you.